to go over
Yes,
to Oman.
a nice place. You have a very nice
I love
beaches.
Oman. I've actually hiked a lot. It's very difficult, but it's beautiful. It's
Yeah.
Oman.
You've been to Oman before?
Yes, many times. I used to drive from Dubai to go, and it's beautiful. I love it's for me, it's real Middle East, right? Because you get the raw beauty, the people, the
Yes.
food. It's
Still the Middle East.
still Middle East.
We don't know
Yes,
for how
Middle
long, but things are changing in Oman also. Good.
It's still the Middle East and things are changing. That is true. What is changing in this oil market on Thursday, May 4th, with Brent crude oil trading up this morning in Asia, up 1% at $73 a barrel. Who would have thought? A little bit above $73 a barrel, has obviously taken a big hit over the last few trading days. The economic noise seems to be somewhat bearish. Let's kick off this morning with Maliha Bengali, founder of MB Commodity Corner. Maliha, your assessment of where all these are, these sort of counter forces are integrating. We had the Fed decision yesterday to go up for 25 basis points. We had another bank collapse, etc. Where do you put it all together for outlook?
So the market really had a big move yesterday when the FOMC, the Fed, delivered as expected 25 basis points rate increase. But what was really astonishing is that he worked so hard to reassure the market that the banking system is safe and resilient. And then a few hours later, we see Pacific Bank Corp looking at strategic options. Honestly, I think the Fed is doing what it can to keep stability, but they really don't know how much of an impact their rate rises have done to the economy. There's some serious impairment, and the market's realizing that. It's not a matter of whether they pause or not, because we think it was a hawkish pause because they've left the door open to data dependency. What this means is that there's severe lending crisis in the economy. All these banks that are going under, there's not really a banking crisis because JP Morgan or other banks are getting bigger, but the fact that we have less lending and more banking tightness means the economy cannot grow. And that's the issue. We're going through a massive deceleration phase, and inflation, as the Fed pointed out, is pretty sticky still. We know it's coming down, but the question is they need to see that 2% print before they can do anything. So the big debate in the market is that the Fed's going to cut, but historically speaking, the Fed has never gone and done a 180 from raising rates to cutting rates. So higher for longer is the key thing here, and that is what the market's digesting. It's quite bearish, right? So we know that there's serious stress in the economy. The oil market is just a reflection of that because it's looking out in the future. Demand across the board, even April data demand for China is not as bullish. We know that Q1 was strong for them because they reopened, but net demand across a lot of indicators, some of our proprietary indicators, is very weak. And I think that's what investors are trying to battle with right now in terms of Fed policy.
Ali Al-Riyami, consultant and former director general of marketing at the Oman Ministry of Energy and Minerals. Ali, we're down at the lower ends of the 70s. The last time we were here a few weeks ago, OPEC Plus members announced a significant cut that's coming into effect this month, and they are due to meet in Vienna in early June. Would you expect another cut to tackle these falling prices?
Good morning, everybody. I don't think so. I don't think so that during this period until June, when they meet personally in Vienna, that there will be any kind of decision to cut, especially that the previous decision was not from OPEC Plus, but it was voluntarily from members, some members of OPEC Plus. But I don't believe that there is enough justification at the moment to cut more production, actually. So we will, I think the OPEC Plus, they will wait until they meet after maybe 1 month from now, maybe less, to take a decision either to continue with the same cuts or to cut further down a little bit of more production, 1 or 2 million extra. But this is not driven by the fundamentals. The price now is driven actually by the economics or the economy of the world, and it is not growing. We have crisis in America. The banks are collapsing one after another. The world, economy is not growing. The inflation is high. So all of this, and also the index and the trading index, and also the manufacturing index in China is not supporting the growth and the demand of oil. So those all these factors, I don't think that if you reduce more oil, it will help the price. And again, I mean, OPEC always, they claim to say that we are not after the price, but we are after the fundamentals. So I don't see any reasons at the moment why should OPEC take a decision to reduce their production. Let's wait and see until June.
Fundamentally, Saudi Arabia wants to balance its budget, so perhaps that's a fundamental of some sort.
That's what everybody says, but you haven't heard any statements from Saudi Arabians indicating that. But you know, there are speculators and also rumors here and there, and you know, the latest statistics shows that each country of GCC how much they need oil price to balance their budget. But those are just you know, let's go in official statements from different organizations.
Let's welcome Victor Yang, Senior Analyst at JLC Network Technology in China, because of course there are some very positive data points now emerging out of China. Maliha referenced the first quarter oil import numbers look positive, and now we have the China tourism back in action after the May Day holiday. We saw a rebound to greater than pre-COVID levels. Yes. 274 million domestic trips over the holiday. That's nearly 20% higher than 2019. China's back. Is that the narrative, Victor?
Yes, well, you have got the data, yes. We just came back from a 5-day holiday today. And what we have been watching from news these days is traffic jams everywhere and tourism spots being packed everywhere. And what was more ridiculous was that people couldn't get a reservation at the hotel, and they had to spend the evening in the washing room in some mountains. Yes, that's like crazy. And it was actually more crazy than before the pandemic. So people are now spending more, I mean, because of the tourism. It's driving up local economies faster than in the first quarter. So we are actually seeing more consumption in quarter two, yes.
Where, Victor, does that signal from a point of view of aviation fuel or other energy consumption, this sort of restarting of the Chinese economy and obviously this big holiday weekend? Are we seeing that reflected in the energy consumption data?
Yes, we see an increase in gasoline and jet fuel consumption quite a large increase, particularly in early May. And diesel consumption grew faster in the first quarter, but now gasoline and jet fuel consumption is catching up. So we expect a faster increase in gasoline and jet fuel in this quarter, yes, than in the first one, yes.
Maliha, we're looking at the sort of contrast here, if you like, between, let's say, the China bulls who are looking at that story versus the kind of U.S. bears, if you like, the U.S. economic outlook sort of becoming more and more concerning. Are either of these two winning? I mean, obviously $73 oil would tell you that the U.S. bear economic outlook is trumping the China bull.
A lot of the stale oil bulls have used China demand recovery as one of the main thesis for an oil price rebound. You've seen this magical V-shaped recovery estimates in earnings of equity companies, but also in oil demand numbers, as though China will magically save the world. It's not that simple. China may be doing better in reopening, but look at what's happening in Europe and US. So the export data is weakening, and you have to take what's happening in the developed markets in combination with what's happening in China. And taking a step back, the tightness in oil has always been in products. We've talked about that for months on end. And now what's happening the last month and a half is we've said that China, India have been very sort of advantageous in taking cheap Russian crude to make a lot more products, and they're sending it out. So the tightness in gasoline and distillate is actually easing off as demand is actually falling off. And that's balancing the oil market. So it's really not just about oil, it's about products as well. Demand is a key factor here. And that's something that's disappointing on the downside, or at least not recovering as much. So yes, the macroeconomic data is affecting what's going to be doing to oil. And look at copper, nickel, aluminum. It's a massive economic downside in prices. So I think that's what needs to be factored into the prices. And people who are just basically basing China to demand is going to help. I mean, their numbers are too high. They're still calling for $150 oil. If we see a massive recession, these numbers will never come to fruition. Yes, OPEC has done a good job in terms of taking barrels out of the market, but they're just delaying the inevitable, right? They're just making it price higher for longer for the wrong reasons, because demand is not there, we feel.
The somewhat talking about the fundamentals of the oil market, we've seen in recent weeks, and again this week, crude oil inventories are declining, drawing down, let's say in the US, and yet oil prices are falling. Typically, the historic correlation between those things are to move in the other direction, falling inventories, rising prices. But on this occasion, we've falling inventories and falling prices. How do you interpret that?
Well, I have a different theory on this. I don't believe on those numbers shown either from America or from EIA. It's just, it's another way of, manipulating, the numbers and manipulating the market. This is the way I see it. I mean, maybe I'm wrong, maybe they are correct, but there is no coalition, by the way, between the numbers or the inventories in America and also the oil price. It's always been together. I agree with you, but there is no fundamentals to allow these two things to go together, because we are talking about two different markets, two different directions. But nevertheless, every time we see any inventories lower in America, then we expect the prices to go up for no reasons. I mean, what that should do with China, let's say, or with India. But nevertheless, those are the things that we used to follow before. But now the world, or these numbers proves to be, they are going to different directions and no more connected. So I believe this is going to be the norm in the coming few months, especially that the dollar now is very strong, and this is another factor that it has on the price, oil price. But IEA numbers and the IPI or API numbers are always nice to have, nice to know. But I don't personally, I don't think that they are genuine numbers that it can drive the market either high or low. That's my view.
Victor, we talked about the China tourism data of the last few days. Of course, people have been locked up for not locked up, but ultimately locked down by the COVID pandemic. And we've seen this rebound in many places. What's the sustainability of this rebound? Because typically it looks like the data shows that the China consumer doesn't really want to spend their money.
Well, if we are talking about consumption, it did grow quite a lot during the public holiday. And say, for instance, when one person travels to another city to see the pandas, say, you can spend 200 yuan or maybe 50 yuan for seeing the pandas, but you can spend several hundred yuan on, hotel, food, and so on. So they will say some data on this. Say if you travel to another city to have barbecue, say in Zhibo, in Shandong, which is very famous now, and you can spend 50 yuan for the barbecue, and then you have to spend several hundred yuan on related stuff. Yes, and so during the holiday, actually they grow quite significantly, but we do not expect such a jump to last in the coming months. We say it will retreat slowly, actually after the holiday, but then recover gradually. not just like the big jump during the holiday, because it's quite different during the holiday. So we just expect demand to recover faster than in the first quarter, but not like the holiday. That's quite a one-off occasion. Yes.
Maliha, we're also this week looking at, we had obviously the Fed yesterday. They did as was expected, 25 basis points in the midst of what is an ongoing banking crisis. The ECB is up next. What do we expect from them? It seems there's a less certainty about what they may do, 25 or 50 basis points.
The ECB usually follows the track of the Fed effectively. Their inflation numbers are a lot higher than the US's. So if anything, they would need to match them and raise by a quarter as they did before. So we expect them to raise rates. And I think when the Fed does eventually pivot, if it does, there's always a time lag. But the Europe has a lot higher inflation problem, structural growth problem than the US does. So yes, we are more hawkish on them raising rates.
And where does that leave the European economy? I mean, despite the traumas of the war in Ukraine and other energy crisis challenges over the winter, which never really materialized, where is that leaving the European economy at the moment? It does seem to be defying gravity.
You're absolutely right. I think the relief recovery we saw in the last 3 months, because gas prices, are trading below 36 pence per therm right now, that's aided in this European recovery. But you are right. There's a lot of systemic issues. And there's even talk about the banking issues in the US spreading into Europe, maybe not as much, but commercial real estate, residential real estate, loans, deposit ratio, these are still issues in Europe as well. And we haven't seen the impact of the contagion yet. But in terms of taking a step back, in terms of the slowdown in credit freeze, it's going to impact Europe. So the Europe economy numbers actually are probably looking a bit bearish, and they probably they're probably the heights here right now, because we could still get a very cold winter and gas prices could shoot higher. That the game is not over there towards the end of this year.
Ali, just coming back to our original point, you were saying that the fundamentals don't indicate why OPEC should cut again anytime soon. But I suppose similarly, a few weeks ago, one might have said the same thing. Is there an argument, or is there any reading the fact that the meeting in June is going to be in person, that the cuts that were made a few weeks ago, or announced a few weeks ago, I should say, was not an OPEC agreement? It was an individual country voluntary decision. Would you expect going into the OPEC meeting in June in person that all of these voluntary cuts will become inside the tent of OPEC Plus and that others may join? Or how do you see that merging, if you like, from the voluntary to the actual official OPEC Plus group of countries?
Yeah, you got it right, Sean. I think what happens always that if there is any voluntary, it happens before, by the way, 2 years ago or 3 years ago.
Yeah, I remember Saudi cut 1 million barrels by itself.
Exactly. Yeah. So, and then what happens is that when they have this OPEC meetings, especially the whole the OPEC Plus meeting, members are attending the meeting, then it is going to be discussed internally. And if the numbers and also the market shows that there is a need for others to join, then yes, the decision will be like let's now go to everybody and try to split the cuts to others. Either they will keep the same volumes, or maybe if the numbers also shows that they need to reduce further down, then the other countries will participate. But
I mean, at the moment, OPEC Plus is still, OPEC research is still showing a 2+ million barrel a day growth in demand this year. Their own data has not changed despite these cuts. Would that have to change in order for these cuts to become consolidated within OPEC?
I think the most important thing is that the market in Asia and how this will drive the demand in the future. And you're absolutely right. I mean, the numbers of OPEC, it shows that there is some there is a demand of about 1.6 1.7 million barrels, but it doesn't show exactly when this will kick in. Then it is just a number that it keep on going towards the future, rather than saying that this will happen in October or November. So I'm expecting, the growth, the real growth to happen in the last few months of this year. So
Well,
this is where
the IEA has forecast that the fourth quarter would be the big, as you just articulating, as much as 2.7 million barrels a day of demand growth in the fourth quarter.
in this environment, Sean, 2.7 million, I doubt it.
That's what it's. That's what
Well, that's what
the
makes me,
IEA is saying.
that is exactly what makes me, uncomfortable with AIA and IEA, whatever.
Well, the argument for the IEA is, and I think OPEC isn't far behind, is that essentially in the first half of the year, the demand growth is only 700,000 barrels, and then increasingly in the second half, it scales up to 2.7 in the fourth quarter, and so the average for the year is 2. Let's go to Victor in China, and Victor, get us a sense of where you think the second quarter China demand numbers will be, consumption and imports. What do those two numbers look like?
Well, consumption will not change much yet in the second quarter. Well, in the first quarter, it grew modestly. Well, let's take crude runs, for instance. Sinopec's crude runs in the first quarter still dropped modestly, say about 3%. And PetroChina's crude throughput grew by over 8%. So, and in combination, the country's crude throughput grew to some degree in the first quarter.
But what was the total barrel number of that?
Well, and is about, say, in metric tons, it grew about 3.9%. And I don't remember the actual barrels per day number. And in the second quarter, there's a lot of refinery maintenance, say, particularly from, in April and May. So we expect crude imports to drop quite significantly in April, probably to about 11.2 million barrels per day. And,
from what?
Yes, from the, imports in March, it hit the second record high, which was just only over, 12.9 million barrels per day, I think. And it was just close, 12.8, probably. And just close to, only second to the record high recorded in June 2021. And, we had discussed why imports in March had dropped, yes, in previous sections too. And in April, one is because of the high base in March, and the second one is because of the refinery maintenance. And refinery maintenance will not change much yet in May. So we do not expect imports to change much yet in May. But we expect to see a jump in June after most refinery maintenance comes to an end. And also because some buyers place more orders after, OPEC announced production cuts because of some concerns about tightening supply and rising prices in the coming months. So we do not expect it to, consumption and imports, to recover yet before June. Yes.
Would you share the IEA and the OPEC view that in the second half of the year, China's imports numbers, its consumption of energy, will grow in comparable to the levels that they're indicating?
Yes, in the second quarter, it will grow. Yes. Yes.
But the second half of the year, from July, August, September.
Yes. We expect economy to recover faster in the second half of the year, and it's oil consumption too. Yes, and imports too. Yes.
Let's go to the survey question, which is tackling the subject of this dreaded U.S. government debt default, debt ceiling issue, which is growing in noise and concern. We had Janet Yellen this week indicate that she identified the date in which the US government would no longer be able to meet its obligations under the current framework of June 1st. And so the question is, how likely is it that the US government, Republicans and Democrats, will reach agreement to lift the debt ceiling by default day, basically the default day on June 1st, that they'll be able to lift the debt ceiling by default day on June 1st. They definitely will reach agreement, probably will reach agreement, maybe will reach agreement, unlikely to reach an agreement. Would you need to store canned beans in your basement, Malia, if they do not reach agreement? What are your thoughts on how significant a deal or how the lack of a deal or an issue this is for the markets?
We think it's good to look back at 2011 and in the past, because there are some risks in terms of coming to some sort of an agreement. Eventually, they may come to an agreement, but I think in terms of the risk factors, look at US CDS spreads, there is a risk of it actually getting a lot more prolonged than people expect. And that nervousness will cause tension in the market that's already very nervous about other factors. So eventually, they may come to a compromise, but it's not looking like a done deal just yet. There's a lot of two-way back and forth. So there's a chance of some hiccups along an eventual agreement. I think that's a risk the market needs to price in right now.
Yeah, hence I put the June 1st date there. I think you could see a lot of government departments furloughed and so on as this drags out over the summer. Ali, what does this symbol, do you think, this continuous difficulty within the American body politic, government, etc., banking crisis? Some argue this is adding up to an indication that the full capabilities of the US economy's best days are behind it than in front of it. Do you subscribe to any of that theory? Is it just business as usual, or is this more symbolic of something more, do you think?
Oh, obviously that this has an impact on American economy, no doubt about that. But how big it is, we will have to wait and see how much that it has an impact in the world economy. But no doubt that the whole market, not only the oil and gas market, but the energy market and also the other markets are being affected by this factor, and also the issue and also the problems with the banking sector in America. So all of this, a combination of a combination of few things, that's all definitely affected the market tremendously. But for how long? And are there any indications in America that this could be solved soon? This is the question that we will have to wait and see if there is any signals of any kind of support from the federal and also from the government to come up with some solutions to allow the growth, the economic growth in America to start again. But at the moment, it's a very gloomy picture, and we'll have to wait and see.
Victor, does this story get much coverage in China? Is it viewed as a significant issue or not?
Yes, it's a significant one. Yes, it can cause quite a lot of impacts globally too. So we also pay attention to this. Yeah.
And just finally, Victor, before we wrap up, I mean, in the past, we've seen China take advantage of low oil prices,
Yeah.
even though this is not, as you say, the cycle and we have maintenance season and so on.
Yes.
Would we expect that Brent in the low 70s and, the downward draft continues, that China, despite maintenance season, might be opportunistic here and go into the international market and buy more oil than is expected in the second quarter?
Well, it's possible, but it's also up to the storage capacity too and the market outlook. Say, if we still expect the country bearish market, even if it's not below $70, it may not buy much. And so there are still quite some factors to decide this.
It should be attractive for the Americans.
Yeah.
The opportunity for the discounted crude is I suppose China, Victor, is already enjoying discounted crude from Russia, and so maybe it's a bit spoiled at the moment. What is the outlook for that continuing? It had reached up to, I think, 20% of total imports. Is that number still looking like the average through the second quarter?
Well, in March, imports from Russia hit a new high of over 2 million barrels per day and took close to 19% of the total imports. Not much change from the previous month. Well, so we still expect this to continue in the coming months too. Say in March, cargoes from Russia were about $10 below those from Saudi Arabia, and versus $8 in February. So not much difference, but there's still some discount. And so we expect this to continue. And yes.
And from that point of view, is there still a lot of capacity in the Chinese storage inventory capacity, which had filled up quite high levels last year? Is there still capacity for more?
Well, not much more yet. I don't think there's still much more capacity for new cargoes. Some a little bit, but not like in 2021 or 2022. No longer.
No longer much room left in the bucket. Well, we'll
Yeah.
have to wrap it up there. Brent crude oil trading a little bit higher this morning in Asia. This probably is getting the most answers here. We'll post that on social media. Probably will reach a deal. I'm not sure. I'm in the unlikely camp by June 1st, which is the sort of key date there. I think the friction within the politics is so caustic that it's going to take them a few goes to reach and you know, like that time when you drive your car and it's on empty and the red light's flashing. I think we're going to spend a little time in the red light flashing of the US government, maybe through the month of June, when everything is sort of on a knife edge. We'll have to wait and see. But Ali Al-Riyami, thank you so much as always. Great to have your insights and look forward to your recommendations in Istanbul. Victor Yang, thank you so much for your participation this morning. And Malia Bengali from the UK, thank you all. We'll catch up soon again. All the best.
Yes,
thank
have
you.
a nice day. Yes.
You too.
Thank you very much and enjoy Istanbul,
Thank
Sean.
you. Yes.
Shukran.
Mhm.